On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope everybody is well. Last week was another good one for global share markets. We had the S&P 500 in the US up another 1.3%. So November very much living up to its reputation as one of the better months of the year. In fact, the best month of the year for the US market historically. We're up 5.3% so far. So on the back of a pretty difficult August, September, October, things are looking up this month. Let's hope that continues as we head toward the end of the year. Other share markets a little bit mixed. Europe slipped 0.2%. The UK was down 0.8%. The Aussie market across the Tasman up 0.1%, and the local market here in New Zealand up just the 0.2%, although it is important to note that US market strength, a fair whack of it came during the Friday trading session. So New Zealand, Australia, and even Europe and the UK would have been closed during the second part of that session, and there was sort of a late rally. So maybe there is a little bit of catch up that we will see in this part of the world early in the coming week. What happened with interest rates and bond yields? The US 10-year Treasury yield up slightly, ended the week at 4.65, so a little higher than where it started, but still well below the 16-year highs of last month. During October, the 10-year Treasury yield pushed through 5% for the first time since 2007. So at 4.65, we're still some way below those levels. Local interest rates, our 5-year swap rate was down about 10 basis points, so down at about 4.9. We hit a 13-year high of almost 5.4% just 3 weeks ago. So we're actually off quite a bit from those highs, off a full 0.5%. From those levels. New Zealand fixed income, and I usually watch the NZX investment grade corporate bond index because it's a very good proxy for the type of fixed income assets that most private investors hold in portfolios. It's returned 4% this year, so a pretty good return. Certainly it has outpaced the local share market, and it's on track for its best year since 2020. New Zealand fixed income was down in 2021 and then down again in 2022. Very unusual to see conservative assets down 2 years in a row, and in fact it's quite rare for them to be down full stop. But 2023 has been a much better year and fixed income has performed well. Looking back on some of the key developments last week, we'll start with central banks, and the only major central bank meeting was the Reserve Bank of Australia. They did increase their policy rate by 0.25%, so they moved to 4.35 last week. Although they're lower than New Zealand, lower than the United States, lower than the UK, they're still at the highest levels we've seen since 2011. And remember that in Australia, a lot of borrowers, a lot of homeowners sit on floating rates. So the RBA does get a bit more bang for buck when they hike interest rates because it does tend to flow through quite quickly rather than being quite delayed, which is what we see here because we all sit on fixed rates. So that was the first increase since June. The RBA has left things unchanged at the 4 meetings since then. So I guess what's brought them back off the sidelines is that inflation has been a little stronger than they had hoped it would be. So that's why they have felt they need to take some action. They do think inflation has passed its peak, but they're worried about the stubbornness of prices, things like services, prices still continuing to rise more quickly than they would like. So they think inflation will keep coming down, but they just haven't made the progress that they had hoped to. So markets still see a decent chance of at least one more hike. from the RBA. Another hike over the next 6 months is priced into the tune of about 65, 70 odd percent. So that could change depending on how the economy develops, depending on what happens with inflation. Although at the moment you would probably, if you were betting on it, you would probably suggest that there's one more in the tank from the RBA. The only other central bank activity we saw last week was that there was a lot of Fed speakers talking, including Jerome Powell. He spoke at an IMF conference. He played his cards reasonably close to his chest, left the door open for further hikes if he needs to, as you would, and made a few comments along the lines of, we're not entirely sure that we've done enough, so still watching and waiting. And I think that's to be expected. The Fed wants to keep people. They don't want to just signal that they're done just yet. They want to leave the door open and give themselves the opportunity to do more. There's one more meeting this year. It comes in mid-December, so we'll wait and see how that plays out. My view is that they probably are done, but I can see why they would want to be a little bit ambiguous with their commentary. The only other notable thing that came out of that presentation from Chair Powell was a slightly amusing sort of interchange between him and some climate protesters that tried to bust into the room and interrupt his speech. I won't repeat the language that he used as he was trying to have them removed, because it was a couple of words that I would growl my children if I heard them using them. But sort of funny. You will get a bit of a chuckle, a bit of a laugh if you Google that, because these high-profile central bankers are usually in the news for the comments they make or the action they take. But last week, Mr. Powell got just as much media attention for getting a little bit angry at the climate protesters and wanting them to get out of there. What did we have here in New Zealand? We had the Reserve Bank survey of expectations for the September quarter. This survey is an important one for monitoring how inflation expectations are developing. And the good news was that over the coming 12 months, expectations for where inflation will go or be fell quite sharply, fell from 4.2 to 3.6. So that's very much good news, probably influenced by that softer inflation print we got, because they do the survey just in the wake of each inflation print. So that came in at 5.6 instead of 6. People were probably quite encouraged by that. However, when you look ahead a little bit higher, so that's probably not what they want to see. 5-year inflation expectations rose from 2.25 to 2.43. That's the highest in 12 months, and still within the target band of 1 to 3%, although moving in the wrong direction. And the RBNZ would rather be seeing these numbers closer to 2 then sort of pushing up, from 2 towards 3. So good and bad there. It probably doesn't dramatically move the dial in terms of what the Reserve Bank might do next. They have one more meeting to go late this month, so another 2 or 3 weeks away. I don't think they'll do anything there either. I think they are finished in terms of their rate hikes, that is. Dairy prices, we had the results of another GDT auction, saw a marginal decline, not much in it. The headline index down 0.7%, probably not a bad outcome. A few people out there thought it would fall further, so you may as well call it flat. That comes on the back of 4 consecutive increases that saw the index rebound almost 17%. In the 2 months from sort of mid-August to not so long ago. So that's been good. Dairy prices still at reasonably subdued levels. We want them to recover over the next year or two, because even at 7.25, which is where the payout is, the Fonterra payout, some farmers will be making a loss. So over the next couple of years, I think you need to see either prices recover, or you need to see borrowing costs come down, so that the cost structure of the typical farmer falls a little bit, or both. We can handle one pretty average season, but you don't want to have sort of 2 or even 3 difficult seasons in a row. Right, looking ahead this week, and the highlight will definitely be the US inflation report. This will be for October, and we'll be hoping that we see further declines in inflation. Markets are expecting headline inflation to have increased 0.1% for the month of October. That will be the lowest in 5 months. That will be good. Core inflation, which excludes food and energy, that's expected to be unchanged at 0.3. So at an annual level, markets are expecting headline inflation to slow to 3.3%. That's the lowest since March 2021, 2.5 years ago. Core inflation unchanged at 4.1. Still down from the highs, still equal lowest with September 2021, same as last month was. So, moving in the right direction, progress. That core inflation is still a little bit stickier than people would like. But some of the indicators have been good looking forward. Look at the PMIs that we saw for October, and I talked about these a week or two ago. They were very encouraging. We saw input cost inflation in the US fall to the lowest since October 2020, and average selling prices posted the smallest gain since June 2020, more than 3 years ago. And I'm quite encouraged by that because it's come in spite of rising oil prices of late. So that was quite good. But that'll very much be the highlight. And I think this is out on Tuesday in the US. Yeah, Tuesday in the US. So we'll be watching that, and we'll get that on Wednesday. Retail sales will be the other key release that we'll get out of the United States. They're on Wednesday, and they will obviously help us build a picture of how the consumer is feeling and thinking and acting at this point in the lead up to the holiday season. We've got some Chinese monthly indicators. Wednesday, 3 p.m. We'll get things like what do you get? Retail sales, industrial production, fixed asset investment, those sorts of things. So I'm not expecting fireworks here. I think we could be in for a disappointing set of figures. The Chinese PMIs for the same period pointed to slowing momentum and, renewed deflationary pressures, particularly in the services sector. So not expecting these to look fantastic, but we will watch and see. That will be on Wednesday afternoon. Also, a bit happening on the geopolitical front. This Friday, another deadline for Congress to avert a government shutdown in the US. So, listeners will remember that we had that deal that was put together to buy them some time. Well, it's nearly expired, so they've got to sort that out and come up with something that is a little more permanent. So, we'll be watching for that, and also the APEC Leaders Week in San Francisco. So that started over the weekend and will continue throughout this week, through to I think the 17th, which is Friday, isn't it? The highlight there will be US President Joe Biden and Chinese President Xi Jinping expected to meet. That is expected to take place on Wednesday. So they will meet, and that'll be really interesting. It comes obviously against the backdrop of a not fractured, but certainly deteriorating relationship between the world's two biggest economies. You had that incident earlier in the year, was back in January, wasn't it, where that spy balloon sort of came across US airspace, and the Americans shot it down and then accused China of sending a spy balloon. So that's made things a little bit tense. And obviously last year, I think it was August last year, where Nancy Pelosi, who was the speaker at the time, visited Taiwan. That didn't go down particularly well. So you have had a bit of a tense relationship. So this meeting will be closely watched, and those issues will be discussed, I'm sure, as well as the conflict you're seeing in the Middle East, the war in Ukraine. Talk about election interference ahead of the US election next year. So that will be something that markets will be keeping a close eye on. On the local front, the only key economic releases will be the October housing report from the Real Estate Institute. I think that is out on Wednesday morning. Yeah, Wednesday morning. And that's the same day as migration figures, which are out sort of later that morning. So we'll get those two things. I'd expect them to both be quite good. The housing market has rebounded a few percent since it bottomed out in May of this year, and I expect that to continue. Maybe a bit more activity, a few more listings, a few more sales. With the market having stabilised, with prices having pushed a little bit higher, I think people are a bit more inclined to put the house on the market, so you might see a little bit more happening there as well. The election's behind us, so a bit more confidence. So I don't think prices will have rocketed away, but a bit more activity and a bit more stability across the housing market would be a good thing. Migration, which has been a big driver of activity, and it's been very helpful in terms of dealing with some of those labour shortages we've got. I know it's a double-edged sword, migration, but I think there is more good than bad for us at this point in the cycle, and it is doing us a few favours at a time that we need them. So personally, I am happy to see those migration figures remain pretty solid. The reporting season, winding down now internationally. We've had 92% of S&P 500 companies already report. It's been pretty solid. 80 odd percent, maybe a little bit more, have beaten expectations at the earnings level, the profit level, and aggregate earnings growth for the S&P 500 has been 4.1%. It was expected to be slightly negative, so that's a good outcome for the September quarter. Looking ahead to the December quarter, the last 3 months of the calendar year, analysts are expecting that earnings growth to continue. 3.2% is what's expected from the same quarter a year ago. And if we look ahead to 2024, all of 2024, the calendar year, analysts are expecting earnings growth of 11.6% relative to 2023. So all of 2024 compared to all of 2023 on a calendar year basis, earnings growth of, call it 10 or 12%. So some people would disagree with that. Some people would say, well, hang on, there still could be a recession around the corner. And if that's the case, that earnings growth looks somewhat optimistic, because in recessions you usually see earnings fall by anywhere between 5 and 25%, depending on the magnitude. So there would be plenty of people that would maybe dispute that, but that is what is being officially estimated by all of the bottom-up analysts out there. Still a few to come, though, even though it is near the end of that reporting season. We've got Home Depot and Walmart in the US. I think Home Depot is on Tuesday. Walmart is later in the week on Thursday. A couple of others too along the way, but those are the two that stood out for me. And two of the big Chinese heavyweights, Tencent on Wednesday and Alibaba. So there's still plenty to come. On the local front and across the Tasman, there is quite a bit happening on the corporate news front. Manawa Energy reporting result on Monday, Napier Port on Tuesday, Serko Wednesday, Infratil Thursday, plus a few AGMs. We've got AGMs from Precinct Properties, Contact Energy, A2 Milk, and across the Tasman, ANZ Bank reporting on Monday. That's really the only major result, but there's quite a few AGMs where we might get some trading updates. Goodman Group, Lend-Lease, two of the big property companies, ResMed as well, which has been under fire because of all those weight loss drugs that are expected to reduce the number of obese people, and many of the customers that ResMed products are supplied to tend to be overweight and obese, same as Fisher & Paykel Healthcare. Those two companies are competitors. So that one will be an interesting one, because we'll be looking forward to hearing what ResMed has to say about those sorts of challenges that it's facing at the moment. All right, that's all for now. Thanks very much for listening, everybody. Enjoy your week, and we'll talk again.